The Japanese yen weakened broadly and dropped to fresh lows against the dollar after U.S. officials expressed support for Japan's anti-deflation policy. The Treasury Undersecretary for International Affairs Lael Brainerd, who will represent the U.S. at the next G20 meeting in Moscow, said that the U.S. supports the effort to reinvigorate growth and to end deflation in Japan. Meanwhile, she also urged the G20 to deliver on the commitment to move to market-determined exchange rates and refrain from competitive devaluation. Meanwhile, Japanese Finance Minister Taro Aso said after a cabinet meeting that he would tell the G20 that the country is firmly conducting monetary and economic policies in order to escape from a prolonged deflationary stagnation. US dollar Japanese yen broke through 94.05 minor resistance and is now heading for the 95 psychological level. Meanwhile, euro yen and sterling yen are set to challenge near-term high of 127.70 and 147.97 respectively. There were also a lot of comments from officials regarding exchange rates. Bundesbank head Jens Weidmann said that latest indicators don't signal a serious overvaluation of the euro despite its recent appreciation. He also warned that an exchange rate policy to specifically weaken the euro would lead to higher inflation in the end. He emphasized that history showed politically induced depreciations show that they don't normally lead to a sustained increase in competitiveness. And, if more and more countries try to depress their currency, it will end in a depreciation competition, which will only produce losers. However, French Finance Minister Pierre Moscovici said that exchange rates can't be subject to moods or speculation, and he called for a coordinated approach at the international level which enables exchange rate stability. It's reported that the G7 is debating a joint statement with commitment of not targeting exchange rates in setting policy and would release it before the G20 meeting this week. In the US, Fed Vice Chairwoman Yellen, a frontrunner to succeed Bernanke in 2014, said that the Fed will continue to take forceful action to increase the pace of economic growth and job creation. And she noted that while the Fed set the thresholds of 6.5% unemployment and inflation expectation of 2.5%, these thresholds are for possible action, not triggers that will necessarily prompt an immediate increase in rates. Meanwhile, she noted that the dollar has been depreciating very gradually in real terms and it has made a very substantial difference to the U.S. current account deficit that has come down a long way and is no longer on what I would refer to as an unsustainable course. On the data front, Australian NAB business confidence